Hi guys. Today we will analyze Vale stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock is a median performer in the overall market. The long and short-term trends are both positive. Support levels are around $18.40 and $16.20. Strong support level is around $11.90. Resistance level is around $23. In the last month the stock has been trading between $17 and $21.20 range. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 40 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth. Even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 14% per year, for last 5 years. We see that the average profit margin of the stock has been around 17% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 144% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Vale Company: very bad, bad, and average. First scenario. Vale will have very bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be very low, -6%. Future profit margin would be low, 8%. Future free cash flow to net income rate would be low, 60%. In this case, the fair value of the stock today would be $14. Second scenario. Vale will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, -4%. Future profit margin would be average, 10%. Future free cash flow to net income rate would be average, 70%. In this case, the fair value of the stock today would be $20. Third scenario. Vale will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, -2%. Future profit margin would be high, 12%. Future free cash flow to net income rate would be high, 80%. In this case, the fair value of the stock today would be $27. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 5.19. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Vale, analysts forecast growth rate around -8% per year in next 5 years, and future P/E around 6. Again, I will use 3 different scenarios for Vale Company: very bad, bad, and average. First scenario. Vale will have very bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be very low, -6%. Future P/E would be low, 5. In this case, the fair value of the stock today would be $6. Second scenario. Vale will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be bad, -4%. Future P/E would be average, 7. In this case, the fair value of the stock today would be $11. Third scenario. Vale will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, -2%. Future PE would be high, 9. In this case, the fair value of the stock today would be $17. As you can see, today the stock is overvalued, $20, even if we expect the company's average performance in future. The fundamentals are good. However, based on estimates for the next 5 years, Vale will show a decrease in revenue, -8% on average per year, and in earnings per share. This is bad. So, the stock looks overpriced at the moment. I bought the stock at $12, and I sold it at $19. I will buy the stock again, when the stock drops below $14. Company's strengths. Brazil-based Vale is one of the world's largest iron ore miners, and one of the world's largest nickel producers. It also produces copper, metallurgical and thermal coal, manganese ore, ferroalloys, platinum group metals, gold, silver and cobalt. Vale's lower costs relative to producers in India and China, as well as high-cost producers such as Anglo, allow it to remain profitable even in depressed price environments. Vale's high-quality iron ore with iron grades around 64% could attract significant premiums relative to the benchmark, particularly if the world becomes more carbon-constrained. Vale's return on assets of 24% and return on equity of 70% are amongst the best returns of the industry. Its profit margin of 41% is amongst the best returns in the industry. Vale's balance sheet is strong. Vale has a yearly dividend yield of 13%, which is a nice return. Keep in mind that 60% of the earnings are spent on the dividend. This is not a very sustainable payout ratio. Keep an eye on it. Risks. Risks include higher operating costs, lower global GDP growth, increased global iron ore supply, and a decline in global steel production. Slower construction spending in China would likely put significant negative pressure on iron ore and copper prices. Ongoing risks related to Brumadinho liabilities. In 2019 due to the dam failure, 270 people lost their lives, and the dam rupture caused extensive property and environmental damage in the region. War in Ukraine can wreak havoc on mined commodity supplies, particularly coal. The Brazilian government occasionally reviews mining royalties, which could allow it to extract further value from Vale's iron ore assets. Vale's investments in non-ferrous business lines, such as coal, nickel, and copper, have been procyclical and expensive, destroying value. Returns have been poor and have weighed down overall group returns. Based on estimates for the next 5 years, Vale will show a decrease in revenue. The revenue will decrease by -8% on average per year. The earnings per share will decrease by -24% on average per year. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.